The circular flow of income and expenditure is one of the most basic ideas in all of macroeconomics. If you appreciate it up front, you get an idea about the basic macroeconomic relationships, and it helps you have a visual representation of some of the modeling efforts we undergo. It's very important, and it's the subject of this particular screencast. What the circular flow really gives you is a picture of the macroeconomy in action. Some people just have a basic challenge when you first think about how do you aggregate the whole economy into one thing, and the circular flow gives you a flavor for that, and it also distills some key relationships that come up over and over and over. So let's start. I'm going to start with a very basic depiction of the economy. And here you can see I just have two things in my economy, two units, if you will. The first are households, and every person in the economy, here they are, belongs to a household. And every organization that produces anything, goods and services, is over here in this box. Those are firms. Now you could imagine, of course, that you have a sole proprietor that lives alone and also has her or his own firm, and we would just imagine that person residing over here for a household and also over here for their business, but you get the idea. They're just two units. There's all the people, which by the way are all the factors of the production at the moment, and all the business organizations. Now, how do they relate to one another in the economy? They do it this way. So here's our first and most basic circular flow. We have these two rings. On the inner ring, we have the flow of a factor of production, labor. So households provide human effort or labor to firms. Everything is made from labor in this very simple economy. And what do they make with labor? They make goods and services. Easy enough. On the outer ring, we see the flow of dollars, if you will, or of currency, however you want to think about it, to whichever economy you want to apply it. And we have that, of course, households supply labor in return for income, and all the income in the economy comes from firms and goes to households. This is, in fact, all the income. And then, as we can see, the firms produce goods and services with the labor, and they trade it for spending, or these categories of expenditure. It's just all one big category here. Now, what's the important point to remember? Well, there are several, but clearly there's no way in or out of the system. Everything stays within. So these flows, or the value of these flows, are the same. All of the income is equal to all of the expenditure. That's just the way that this is going to work. And that's what makes this important. That's why we call it the circular flow of income and expenditure. It's because these things are equal. So let's take stock of the few most basic points we can make so far. The first is it's a closed system. And that ensures that incomes have to equal expenditures. Or if you want to say that the value of the labor provided to firms equals the value of the goods and services provided back, all of that just keeps it together, and it shows us that in equilibrium, all the income has to be spent on all the expenditures, and we could see how the choices of households might affect what firms are able to do with the factors of production that they receive. The second one is really basic, and that's just the one I've said already 2 or 3 times, and that's that incomes equal expenditures, or that income equals expenditures. And that's critical. If you understand those two basic points, you actually get a lot of what macroeconomics is about. We can study or measure the economy by looking at the sum of incomes, or we could study the economy by looking at the sum of expenditures, and in fact, we typically do both. So that's the most basic circular flow diagram. It's a little too simple, however. We don't have some key entities like the government or financial markets. And we don't in general think about firms and households always trading directly with one another. They usually trade into some larger market, like the market for goods and services. And so what I'd like to do now is update this to a little bit more sophisticated economy. And here's my more sophisticated economy, which looks good. Now we have a few other boxes. I'll explain what they are. I think they make perfect sense. But we have here financial markets, so these are savings institutions, or banks, financial market institutions with which you're familiar. We have the government. There's just one government in this model, but it's the whole thing. And rather than have firms transact directly with households, We have them trading into a market here for factors of production. I'll explain that in a second. And down here into a market for goods and services, which then transmits payments over to firms. I also got rid of one of the rings here. We just have one flow, and I'll explain what that is. So let's build it and label everything accordingly. The first thing is that firms take resources. We would normally have something like a production function, but they take resources to produce goods and services. And in this economy, there are two basic resources. The first one is pretty straightforwardly just labor, which is uppercase L. Sometimes we put a bar over the L, which just means that it's a fixed amount or assumed to be fixed for a period of time. Firms pay labor this amount, the wage rate times L. So W times L are all the payments that go to labor in this economy. That's not the only factor of production, though. We have at least one more. And in this economy, we have one more, and it's uppercase K, which stands for capital. These are all the things that you may be familiar with, the machinery, plant property and equipment, things that go into making other goods and services. It's actually a really broad category. Only new homes is it's mostly expenditures by firms. New homes would be an expenditure by consumers that would go in there. And what firms pay capital in our model is a very important variable, little r, which stands for the real interest rate. W times L plus R times K equals the sum of all factor payments, and that's what I'll label this flow from firms into the market for factors production. On the other side of this, out of the market for factors of production are all the payments that goes to households, and all these payments are just called income. It's the same income from before, and this is all the income in the economy. It's just the sum of these two things. Think of it this way. Everything in the economy is owned by people, so they supply all the human effort, which is the labor, and they own all the capital. So ultimately, all of these payments have to make their way back into households, and that's just what we model here. And now we can see that households have a series of choices to make. The one that's already drawn in is the simplest one, and that is that they can buy things in the market for goods and services. And we label one category. It turns out to be the biggest usually, and that is uppercase C, which stands for consumption. Consumption are purchases of things that are used up usually in a short period of time, like food or clothing, and that's what goes into this category. This then becomes payments, and the payments that come out the other end, along with some other things I'll show in a moment, are just firm revenues, and I'll just put revenues here. These are all the revenues that go into firms. Firms use these revenues to make factor payments. But we need to complete our model here, and the way to do that is by showing the other relationships that weren't present in the previous simple version, and that's to take account for what happens between households and these other two entities. One of them that's really important, obviously, is the government, and the way that households interact with the government, at least in this simple economic sense, is they make a payment to the government, and the payment that we're interested in here are called taxes. So we'll just label that uppercase T, big T there, and these are all the tax payments into the government. Now, what does government do with taxes? Well, it spends the tax revenue, and that's what we'll model here. We'll just show this flow coming downward into the market for goods and services. They buy things like anybody else, almost like anybody else. And we just label that uppercase G, which stands for all of the purchases the government makes in the market for goods and services. Now, what's clear is that these two items don't have to balance, and frequently don't, right? Government spending, uppercase G, can be larger than T, and if that's the case, we would have a deficit. But we don't have a way to showing that on the model here until we expand the model a little bit. Obviously, we could also have the reverse. We don't often think about it that way, but the government could also take in taxes more than it spends in the market for goods and services, and in that case, they would have a surplus. How does this work out? Well, the balance goes into financial markets. Let me see if I can draw. There we go. And what happens here is that governments take the excess or deficit they have here, and we're going to label that savings, but it's one subset of national savings. I'm going to label it S superscript PUB for public savings. There we go. And this is public savings. Imagine the situation where T is greater than G. Then you'd have a government surplus because they'd collect more in taxes than they spend. And the balance, we'll call that public savings, and that's going to flow into financial markets where it can ultimately make its way out in a way I'll explain momentarily. You could think about that as the government sort of compelling the public to save by taking in more of their income than it actually spends. Of course, households can do that themselves. They don't just have a choice to consume their income or give it to the government. They could save, and that's what we'll draw here. I'm going to label this also S, but S uppercase PUB. Oh, sorry, PVT for S, private. And this is just going to be private savings, so that's pretty important. And this also flows into financial markets. The model is almost complete. But let's look at what happens in financial markets. We have two flows coming into them: savings from households directly, private savings, or savings from the government. And financial markets don't just hold the money. What they do is they channel money from savers to borrowers. And what they do in our model is they take that money and they channel it into investment purposes. And that's what we're going to draw here. Investments are goods like other goods. They're also bought in the market for goods and services, but they're usually of a different type. Your textbook, any good textbook will describe that well. And that's just uppercase I, which stands for investment. Now, of course, you could also imagine these flows netting out. You could have a deficit from the government, and you could have a surplus of private savings from people, or vice versa. And we can work through all of that. But now the model is more or less complete, and you can see what happens. All of the income in the economy, which comes from the provision of factors to firms, is allocated by households. They allocate some to private savings. They allocate some to taxes, which the government requires, and they, in this case, would consume the rest. It goes into the market for goods and services. Also flowing into the market for goods and services are purchases by the government and investment flows, which are first channeled into financial markets through these two savings flows. And here you can see the whole economy as one. And if you think about it, you could see how we could talk about factor payments to measure the economy, or we could talk about incomes, or we could talk about these expenditure categories. And here are the big three ones we have in our closed economy: consumption, government spending, and investment flows. And if we want to measure the economy, this would be equivalent. You could measure the economy right here. And that's often the way that we do it. But it's important to recognize that it's just not some accounting exercise. These are also parts of a relationship between specific and important entities in the economy. You can also see a lot of the terms that we're going to use throughout any good macroeconomics course, and some understanding of why we can speak about incomes and imply something about firm revenues all in the same breath. So that's it. Let's take stock and select a few key takeaways for this screencast on the circular flow. I think the first key takeaway, and it's an important one, is just that we have this basic relationship illustrated visually here. And that's, of course, that income equals expenditures, or that Y, which is income, I'm choosing the same color here, is equal to these big three categories of expenditure in a closed economy model: consumption plus investment plus government spending. And it's just those three for the moment. We don't have any international trade yet. But you can see that income is everything in all the income in the economy flows into households, and it all ends up here, C, G, and I, into the market for goods and services. So in balance and equilibrium, this certainly has to be true, and income must equal expenditures. It's not just counting the economy, it's expressing an identity that must be true. So that's one. Let's think about a second big takeaway, which you can also see visually and which comes up a lot later. In fact, it forms the basis of some of our modeling, so it's better to get a sense of it earlier than late. And it's this: savings, and that's national savings, big S, equals investment. You can actually see that because national savings is the sum of private savings and public savings, and that's everything that's flowing into financial markets. And financial markets aren't holding on to anything. Everything is flowing back out, and the only flow out is investment. So that's the visual depiction, and you can see the key role that government plays in that process. But we could also just derive it. So let's do a little bit of the math, and I'll start with the definition of private savings. You can actually see it here. What's happening is that private savings has to be the sum of income. Maybe I'll switch color again to make it as clear as possible. So it's income minus consumption flows here minus taxes. It has to be. You can see that households receive Y and they spend some of it on T, taxes, and some of it on consumption. Everything else, the only other arrow leading out of a household, is private savings. So this is just the definition of private savings. Public savings is a little bit simpler. It is simply taxes that flow into government less government spending. And if we add these two lines together, we get national savings, which is big S. It's actually not any bigger, but we'll call it big S. And we can see what that's equivalent to because, well, we have a plus T here and a minus T here. So it's just equal to Y minus C minus G. And that's about as plain as it gets. You can see that it's Y minus C minus G. Now, if you actually went back up here to the income equals expenditure identity, you could also see that if I simply subtracted C from the left-hand side and subtracted G from the left-hand side, I would have Y minus C minus G equals I. And that just must be true. And that's critical. When there's equilibrium in the market for goods and services, savings, national savings, equals investment. And this little relationship will come up over and over and over. And it will also be the foundation for our suppositions about changes. So suppose government spending went up. From a given state of the economy, government spending went up. All else equal, what happens? Well, we could see that if G went up here, then that would mean this set of terms would go down in value. So savings and investment would fall as well. We can come back to that, but I think that's about as straightforward as it gets. So keep this in mind and keep this visual representation in mind. It's critical. The last one I'll mention is just to say, this is going to sound really simple, but it's all one thing, or all one system. Sometimes we talk about the economy and speak about incomes, or you read about the economy and there's a discussion about incomes. But that also must be some reflection of what's happening on the expenditure side. And when we talk about factor payments, we're not talking about some disconnected part of the economy. It's intimately connected to what's happening on the income side and what's happening to households' choices about expenditures, and even the government's choices about how to balance taxes and its spending versus what it can borrow or lend in the financial markets. So it's really all one system. So changes to the real interest rate, which we will think about, will affect incomes, and that makes perfectly good sense. Or changes to households' choices about how much to save versus how much to consume will impact firm revenues and have some echo effect, if you will, on factor payments and incomes. So it's all one system, and this is how we think about the macroeconomy. And that's about it. For an introduction to the circular flow, I think that is sufficient. My advice is spend some time, don't give it short shrift. Understand the circular flow, and you'll build some really critical intuition for the bigger macroeconomic models yet to come.